welcome to Friends That Invest. You're joined today by your host, Sim. I'm a financial author and investor, and I'm here to tell you about all things investing and personal finance. This episode is something I'm very excited to share. I'm going to run through all the good pieces of advice that you have been told over the years that you've learned from social media, from financial advisors, often from your parents, even probably things I may have said in the past. I will put my hand up now and say I am not above this. And these have been things that widely at the time of listening to them, you go, yeah, that makes sense. But they are bad pieces of advice. And I am here to share them. I'm here to break them down. And before I do, I just want to say, I have had such a big lunch. I am bursting at the seams. My stomach is out of control right now. And there may be a few cuts in this episode. And the cuts are going to be from me burping nonstop. So just take it with a grain of salt. The idea of salt just actually makes me feel worse. Just take it. It will be okay. We'll work through this. So the first mistake that I have made is the idea of sell at the highest point and buy when the shares are lower. And I remember seeing this advice and just being confused by it because, yeah, of course, that makes sense. Like, you don't sell when prices are low, you sell when they're high, and you don't buy back in. But I remember seeing people be like, oh, well, you know, the S&P 500 is dropping. I'm going to sell now and then it will drop further and I will rebuy at a lower price. Like, let's say it's like $90 right now. It's not $90, but let's say it's $90 right now and it's dropping. So maybe I'll sell at $90 a share. And if it drops down to like $80 a share, I'll rebuy back in and I'll have more shares for the same amount of cash. And therefore when it goes up, I will go up more. And I just remember like, what kind of boy math is this? And it actually does make sense that you can sell shares as they're dropping and then buy them back as they go further. But you have to be right twice. You have to be right that when you sell down your share, the share continues to drop. And then you have to be right that when you buy back the shares continue to then suddenly start rising. And the likelihood of timing the market is so rare. It is like a pink Kelly bag. Like, it just doesn't. I actually don't know if I've ever seen a pink Kelly bag in real life, but then again, I don't actually live in a place where a lot of people have those kind of bags. In saying that, it is rare. It is like meeting a man that is emotionally intelligent. It is rare. It is hard to find. Now imagine meeting two emotionally intelligent men. Like, imagine having back-to-back consecutive relationships of two stable, decent human beings. That is like trying to time the market. It doesn't happen. It is really rare. You might get it right once. Maybe boyfriend one was good, boyfriend two, maybe it was the other way around. Usually it is the other way around. But what ends up happening is it is bad advice to try and sell your shares when the market is high and then hope that the market will somehow like drop to the bottom and you will rebuy back in. And I have actually tried to do this recently and I kind of slapped myself on my own wrist. I was like, no, Sim, this is bad. You attempted to do this. On the positive side, you might make a quick return and like make quick money. On the downside, you might actually lose out more. So don't even like bother doing it. So I'll put my hand up and say, I have done this, but I do not recommend it. It's so difficult to be right twice. Now, this leads me to number 2, the second popular money tip that you should absolutely ignore, which is that Bitcoin is the main or the best way to hedge against inflation, or that Bitcoin is a good way to hedge against inflation. So just to like break things down in really simple terms, Bitcoin, as we know, is a cryptocurrency. It is a investment vehicle or option or asset that allows you to buy into something that has a certain amount of that asset available. There's only so much Bitcoin in the world, and therefore it is seen as a finite resource. There's only so much of it, and therefore if there is more people that want to buy it than there is supply, the share price of Bitcoin will go up and it will hedge against inflation, just like how gold is a hedge against inflation. Now, my personal views on Bitcoin is that unlike physical gold or gold ETFs, there hasn't been a long enough time frame where we can solidly rely on Bitcoin acting the same way as gold. It will never act the exact same way as gold because it is not gold. It is a completely different asset class. That is like saying growth stocks will act like value stocks. They're both stocks, but they're both investments. They're both things you can invest in, but they are not the same thing. And so I'm not against someone going, well, Sim, I really like Bitcoin. I want to have a little bit less than 5% of it in my overall portfolio. I'm like, that's so fair. Go ahead. But to say, I will have Bitcoin instead of gold, or I will have Bitcoin instead of bonds. No, we don't do that. That is just such a highly risky, gold and bonds are meant to be your low risk asset class. And then you look at Bitcoin and how fast it can drop or go up. I wouldn't call that a low risk asset class. I would call that a very, very, very risky asset class. Whereas you look at bonds and you look at gold and they might go up 2%, 3%, 4% a year, and that's it. But they don't drop the way Bitcoin drops. And so to have a portfolio of just shares and just Bitcoin and be well, it hedges against inflation, I'm not a fan of that. And this is probably quite a controversial opinion because I've spoken to financial advisors that have been yeah, Bitcoin is a good hedge. And I genuinely disagree. And so in my own portfolio, I don't have Bitcoin. I do have gold. I do sometimes have bonds, which I get rid of every now and again, but I do not have Bitcoin as a hedge. I would only add it if I wanted exposure to crypto, not as a hedge against inflation. This then leads me on to the third tip to ignore, the third financial piece of advice that is completely wrong, which is that you cannot be wealthy through investing. I see this turn up every now and again, every couple of months, there'll just be this one viral video, and I know the creators that do it, but I'm not going to name names because I don't like having bad blood with anyone. I don't want to be you're wrong for this. I mean, I've probably said stupid things in the past myself. However, there'll be people that say things like the share market only returns 7% per year. And if you rely on that, you'll never get wealthy. That's not a way to grow wealth. I completely disagree on the premise that the share market is not a way to get rich quick. But there is no way to get rich quick. If there was, I would be telling you about it because I would have tried all of it. I have tried drop shipping. I have tried print on demand. I have tried building businesses. I have tried investing. I've tried side hustles. I've tried a traditional job. And out of every single option, I have found that the best way to build wealth is to increase your income, which for me was through having a business, but it could also be by having a very highly paid job, becoming a doctor or going through engineering school and working in AI and doing incredibly well in that field. It depends on your personality. You could make $200,000 from owning a business, but you could also make way more than that if you had a very good job in engineering or a very good job in finance. So I'm not really I don't feel strongly about the job that you take or the way that you increase your income. I just feel strongly about making sure that you can increase your income. And it's about taking that job, keeping your expenses low, trying to avoid all the nice lifestyle creeps that come up, every now and again, something can give. You can spend a bit of money, we're not trying to have a sad life out here. And then using the leftover money that you have, the high amount of money that you are saving and putting aside and investing it. That is how you build real term wealth, because wealth is not a high salary. A high salary can go away, sadly, at any point in time. I don't look even at my own business, at friends that invest. I don't look at that income as guaranteed, because tomorrow Instagram could go away. Tomorrow YouTube could go away. Tomorrow brand deals could go away. Our investing masterclass could go away. My book could stop. So there are so many. I could stop doing speaking engagements, or no one wants to book me anymore. There are so many ways and reasons for things to not continue. And so I look at my own career as that of a athlete where I might have a few good years, but at the end of the day, I don't know if I can rely on that. And so it's not through a high income that you become wealthy. It is taking a normal income, trying to improve it as much as you can in terms of increasing that salary, getting those pay rises, moving jobs, all that good stuff, and then investing that money. Because if you invest every single month and you're just putting $500 away every single month, and you do that for 40 years, you will retire a multi-millionaire. You will have over 2.4%, I want to say conservatively, and that's if the market returns a 7% annualized return every single year. Now, if you go, well, Sim, I could do that, but that's actually not that much money. I really disagree. $2 million is nothing to bat your eyes at. And the wealth that is created is the wealth that is compounded. If you think about how much money people are able to make in their incomes versus the growth of assets over the last 5 years, I can say with confidence, probably even 10 years if you look into the data, it has been assets that have grown. The capital gain of assets has far outpaced salaries. And that is why it is so difficult to buy a house as a young person, because our salaries only increase a certain amount, but house prices have skyrocketed in these very expensive cities like Sydney or Melbourne or Auckland or Toronto, London, New York, San Francisco. I just feel like I named every single large city in the OECD. But the idea behind it is that income does not increase as fast as assets. And therefore, it is so important to invest in assets. And of course, I'm going to be a little bit biased because I am very passionate about the share market and investing in shares, and I'm very passionate about assets. But it doesn't have to be shares that you grow your asset portfolio in. You can do it through property. I mean, I don't want you to do it, but you could do it through Bitcoin. You can do it through ownership in private companies. You could even start your own company or put sweat equity into your friends' companies and be like, hey, I'll help you grow your company. I will do it for 10% ownership and I'll work in it for free, get it off the ground with you. That kind of ownership is what is going to build wealth. Not that this is a good example, but Mark Zuckerberg, Elon Musk, Jeff Bezos, these men have grown their wealth significantly, not from their incomes, but from the shares that they own. And so I do understand when people are don't invest in shares. It's just, what's 7%? But 7% is a really good return. And anyone that's promising more than that, insanity. I do not trust a person that tells you that you can make a higher return in this other asset class or doing this other thing. 7% is a really, really, really good return for the level of risk that you are taking by investing in shares. And growing your wealth isn't meant to be this thing that happens overnight. It's boring. It takes time. I think about when I first started making money in 2016, and it's taken me 10 years to get to a point where I'm a lot more comfortable and so financially secure. But it took a decade in a way to reach that goal. And it's not in that first couple of years, I was saving really hard and knowing what I was doing and investing well. I laugh now. I spent so much of it at Sephora and going and eating out and spending money on just anything and everything. But when you figure out, hey, if I take this money and I invest it, and then the investments grow more money, and then over time the investments can overtake my salary, that is the dream situation. That kind of leads us on to number 4. The fourth thing that I have heard, the fourth piece of advice that I think is actually quite terrible despite it being very popular, and that is leverage investments or using margin to invest. The first time I heard of this, I was surely I've misunderstood this, because what I heard was that you can borrow money with an interest rate on that money. You can then invest that money in the share market in hopes that you make, a higher amount of money. You can then sell down your shares, pay down the debt that you took, and then have some money left over. Why would you do that? Who in their right mind? I will just dial it back a little bit, but I will say there is no good reason to take out money with an interest rate and then put that money in the share market, which you have no control over, and hope that those shares go up in value, because that share price is not up to you. But what is guaranteed is the interest rate. And yes, your shares could compound, but without a doubt, your interest rate on your loan will 100% compound. And there will be more of a chance that you default on that loan and your returns don't reach what they should in the time frame that you need to pay back that loan. Why would you invest with margins? Why would you take a loan and invest that money? That is not the reason why loans exist. Loans exist to allow you to leverage that money in property, in buying a business, in taking out a loan to redo your house, to invest in making it look nicer and therefore increasing the value of your house. That's why you can remortgage to have a renovation loan. But to invest in shares with a margin, and I just know these people are not let me take out $10,000 to put in the S&P 500. They're obviously not thinking like that. If you're going to take out a margin, they're probably going, well, let me invest it into growing this one company. It's just going to do so well. Let me put it into a SpaceX IPO. No, please do not, for the love of God, invest in margins. Invest in anything to do with borrowing money to put in the share market. I wouldn't let my mum do it. I wouldn't let my brother do it. I wouldn't let any nieces or nephews or future kids do it. And I would not let you do it. It's how I feel. And I'm sorry if that's tough. I'm sorry if it's too much, but it is how I feel. Now, the fifth thing to avoid, despite it kind of being something that we've seen come around time and time again, is day trading. Now, if you are an OG Friends That Invest podcast listener, you will know how I feel about day trading, to the point where we have seen email scams go around where people are pretending to be us. And it's not us because the email is friendsthatinvest@gmail.com, and nothing that comes from us ever ends in a gmail.com. It's always hello@friendsthatinvest.com. But anyway, that aside, the reason why so many people realize it's a scam is because they're always hey, it's Sim. Wink, wink. I am starting to day trade and I'd love to teach you how to trade. You should follow my, and then they take you to a scam website. But the reason why so many people have come to me and been Sim, I knew it was a scam. And I'm how did you know? And they're because it was offering day trading. And we know that you are so anti day trading. And I'm not anti day trading because I'm anti men sitting on their computers. It's not that. I'm more anti bad financial decisions that are completely backed up with data. And the data says that 99% of people that day trade do not make their money back. If I was to say to you, hey, give me $1,000, there is a 99% chance you will not get that $1,000 back. Would you give me $1,000? No, because you are of a mentally sound state and you understand that that would be silly. And so you would go, Sim, I'm going to keep this money because I can at least guarantee that if I put it in a high yield savings account, I could make 2, 3, 4% returns just with interest on that. I'm going to do that. But day traders, they believe in this idea. Maybe I'm being harsh, but also I just feel I need to put my foot down on this. They believe that because they are choosing the shares, they're well, Sim, I'm going to invest my $1,000 and I just know what's going to happen in the market. I just can guess that so-and-so company is going to do well. And because we have such a belief in ourselves, you have to understand 50% of men, or even more, I think it was 80% of men, think that if they were given the opportunity to land a plane, that they could land a plane with no experience. We're not talking about pilots. I'm talking about just civilian men. So we just have a high level of belief in ourselves, and yet it's not always a belief that is backed up by data. And so I'm telling you now, do not day trade. Do not let the people you care about day trade. And if you get an email from me saying that you should start day trading, even though it is a scam or I have like been coerced in some kind of, I'm probably like strapped up to a chair with like a gun to my head and they're like, write this email. But I would never, 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 never encourage day trading, which then leads us to our fifth and final piece of advice that I don't want you to ever take that has been popular. And this one might ruffle a few feathers, especially for our investy besties that live in areas where house prices have continue to go up, or if they've always been taught, especially if they're like me, you have like a South Asian background, you're always taught invest in property, prices go up. That is not always true. Investing in property is not a guaranteed way for your money to increase, and house prices do not always go up. I was once at a like talk where you sit down in a circle and you know those like Jubilee videos where it's like capitalist versus socialists. I was in one of those with SBS Australia, and one of the people said, well, I invest in property because property always goes up. And I remember just thinking, oh my God, no, like that is so incorrect. We have just been spoiled with good property cycles, but property in the name has a property cycle, and the cycle means that sometimes it goes up, and after about 7 to 10 years, it goes down, and then it might go up, you might have a boom, and then you will have another bust. And at the time of this recording in 2026, we are at a property bust, especially in Australia and New Zealand, where the construction has just gone through the roof in terms of costs. The interest rates are still very high, and myself included, people that have bought property in like 2020, 2021, 2022, we've all seen the house price of our house drop. I smile, but I'm smiling through the pain. Some people have seen a 20% drop in their house price. And these are like young people that have worked so hard to finally be able to afford a home, and then the house price has dropped. And I've learned to just accept it. And again, I'm holding on to property for 20 years, 30 years. So I don't mind the slight decline, but to say that house prices always go up is such a myopic view of the property cycle. And again, it's not rooted in data. It is just rooted in like what feels like is happening. And it is so city specific and country specific, because if you have a house in like Alberta, that has not gone up the same way a house in like Toronto has. If you have a house in Idaho, it has not gone up the same way a house in like Brooklyn has in New York. And so it really is a bad piece of advice to tell young people that you have to buy a home at whatever cost in any city because it will go up. I do believe you should buy a home for safety, and you should buy a home to have roots, but do not buy it in the hopes that the value of the house will go up. Buy it in the hopes of you have this asset and you can either live in it or you can rent it out, but not like in the idea that you buy it and you'll get like a 5% return every single year, like we have seen in the last 15 years of the property market, where things have just been a little bit too good to be true. It is not something that we expect to last. And so with that, there's actually not many other pieces of financial advice that I have looked at and been like, that's kind of terrible. These are probably the main ones that I've come across. And I'm like, oh, interesting. I don't know if I feel the same way. And so I hope you've enjoyed this episode. It's been like a nice, short and sweet episode. And if I could ask one thing of you, just one thing, please take a screenshot, put us on your Instagram story, tag friends that invest. It helps us grow the podcast so much more. And it allows us to reach more women that want to understand financial literacy. And honestly, what else could we ask for? So with that, I'll see you next week.